work on part B onwards. Part B onwards. There are specific assets in which company wish to seek advice. Company holds a certain non-current asset which are in development area and carried at cost less depreciation. This asset cost 3 million on 1 June 2003 and are depreciated on a straight line basis over useful life over 5 years. Impairment review was done on 31st May and projected cash flow relating to this asset as follows. You got 280, 450, 500, 550. Projections and notice the projected cash flows. Okay. Projection and notice that the resultant value of the above carrying amount. Okay, the projections and wish to reverse impairment loss incurred. Government has indicated that compensate the company for any value loss up to 20%. So here, there is something to do with the projection. The management have feel that the projection values have changed. Okay, let me just put this down for you. Add some sentence here. Following year. Okay. Let's look at the word following year. The following year, just add this in. Add that in. Well, let us use the 5% rate. Okay. So before we go on, let's look at the first part. This asset, can you do an impairment review? Okay, very clear here? What you have to do here? That's theory, right? You have to find the value in recoverable amount. The recoverable amount. Don't use the word NRV. NRV is a very dangerous word because NRV is actually a different definition. Different definition, slightly different definition. Okay, NRV means it's price minus cost to sell. The cost to sell could include repair costs. Understand now? Could include completion costs. That's related to inventory. You know, inventory, WIP, work in progress. When we say NRV, it's your price you're going to sell at minus your marketing costs minus the cost to complete. Got it? Which is not the same as fair value less cost to sell. Fair value less cost to sell, the moment they use the word fair value, it's market price. Whereas NRV will use your selling price. So the point of references are slightly different. Are you clear or not? Got it? So you must be very careful with the usage. Again, I repeat, NRV refers to your selling price. What is your selling price minus your cost to sell, your marketing cost. Got it? Whereas fair value less cost to sell tends to be market price minus the market cost related. It's the less cost to sell here refers to your transaction cost. Fair value is minus transport cost. So before I go on, I just make a side note. You better know the difference between the two words because it is a source of confusion. Is NRV the same as fair value? Is it the same? Not really. So NRV is what? Selling price, marketing costs, and completion costs. Okay, are you clear that part? Whereas fair value is what? Market price less. So this is less. I'm going to put this as brackets, red color. Okay, let me just put this as red color. Are you okay in this part? Fair value less, market price less, transport costs. Then if I say fair value less cost to sell, is going to be fair value less okay, are you clear on the difference? Very clear? So don't get confused with these words. What is value in use? But don't forget, a fair value could also mean you understand? It's not necessary market price. Clear? Not clear? So you could then use PV. You can use so there are a few ways you can do, Does that make sense? So you got to be careful with that fair value word. It's not so straightforward. Value in use is just one word. Pre-tax or post-tax? Pre-tax or post-tax rates? This one will be pre-tax or post-tax? You need to be aware of all of this, because there's not that much measurement into your system, right? You don't have that many measurements in your system, correct? You should master all your measurements. You should know how to, because measurement is easy to get marks, If the question is on measurement, you just need to know how to calculate it. Calculate it this way. They have calculated it wrong. This is the right way to calculate. So an exam question of measurement will just play with you here only. Are we clear? Make sense? So example, in an acquisition, they shouldn't use NRV for inventory. They should use fair value. When you acquire a subsidiary and they got inventory, you don't use NRV as their valuation. That's the wrong valuation. You use fair value. Got the idea there? Cannot. Got it? Can I move on? Okay. Clear on this measurement issues? Yes, no? Got it, Okay. I think you should know how to handle that. Okay, now, so the first asset, how much is the value in use? Let me just break it down like this. You got carrying amount, and you got value in use. So your impairment is how much? How much is the carrying amount? 3 million straight line basis over a useful life of 5 years. How much is the carrying amount? Anybody knows? Simple mathematics here. No, it's not complicated. 3 million, 5 years, and how many years has passed? This is a straightforward question. You should get this type of question. 3 million, 1 June 2000x3 is 31 May 2000x4. That's about 1 year, is it? Yes or not? So how much is this? This is going to be 3 divide times 4 per 5. There, let me try that again. 4 per 5. 2.4. Did you get 2.4? Alright. The value in use is going to be the discounted amount. How much is the discounted? Well, they've used 5%. Use the 5% rate. Do you know how to discount at 5%? It's going to be 280. Well, I think you get about 1.56, yes, no? Can you get 1.56? Can? Okay, done. You have to discount everything correctly. Can okay? Can right? 1.56. All okay? 1.56. Yes? No? Can I move on? All okay? Got it? Okay. The next point that you should have got is going to be done. Can I? Okay. The next one you should have got is this will be expensed to P&L. Okay. What about the grant? You see, there's something that they say here. The government has indicated it may compensate company for any loss in value up to 20% of the impairment loss. Can you get the 1.56? Yes, no? Okay. The grant from the government can be recognized when it's receivable. The reason and reasonable assurance that conditions of the grant will be met. How much? How much is this? What do you think? Okay, do you understand how the grant was talked about? Yes, no? Are you okay? Right. Let's move on to the next question. All right. Key holds a non-current asset which was purchased 10 million on 1 December 2001. Expected useful life of 10 years. On 1 December 2003, it was revalued to 8.8 million. At 30th November 2004, the asset was reviewed for impairment and written down to its recoverable amount of 5.5 million. Okay. How do you handle the second asset? Okay, let's calculate the amount. The way I calculate this is to set up the date first. The dates up here. You got your revalued here. You got your original here. You got your what are your dates? You got 1 December X1. What is your original value? 10. It was revalued to 8.8. These are the information you have in the question. Yes, no? Put the original and the revalued amount. Whatever you have, you put first. Are we okay in this part? You put this table out. Whatever you have, you put first. Okay. What's the life? Okay, let's figure out the life also. Life was 10 years, okay. Are we okay so far? Got it? Any question on this table? You okay with this table? This initial setup of the table should be okay, right? Now, the next question is, work out this one. How many years life here? Here would be 8, here would be 7, yes or not? Okay, good. Right. Now, that means this should also be 8 and 7. Now do the original first. Always get that original first. Do the original standard depreciation. What happened to the non-current asset on a normal basis first. Get that row done first. Alright. Next row. How much would the revalued amount be here? Depreciated amount. How much is it? Here's 8.8. Here should be. Can you get that one? The last one is 5.5 here, correct? Yes, no. That's the information you're impaired, 5.5, correct? Okay. Do you think you can get this? What are the numbers you have to work out? Okay, these are the numbers you have to work out. This is the first number you have to work out. I'm going to put that in one color. The first number you had to work out was blue color. Then the next number you had to work out was this one. Okay, done. That's all the numbers you have to work out, Everything else is kind of like obvious. Okay, so if you get a question like this is another thing that you have to work out. Okay, okay, so yes, no. Do you think you can work out all these numbers? Yes, no. Set this up. If you get a question with PPE and its revaluation up, down, work it out. Okay, now that you know this, I'm going to just talk about the impact. Done. Are we okay? Got it? Any questions there? Do you know how to get the number now? 0.7, 1.5. Yes, no. Okay, let me go through. 0.7 is the difference between these two. If there is, remember, if there is a policy for transfer of depreciation, policy for transfer of depreciation, what it means, a policy for transfer of depreciation means this. That's the policy issue. Okay. Understand the meaning of policy issue? If there is a policy, this entry will occur. They will move money from the revaluation reserve to the retained earning. Got it? That is if there is a policy of transfer for excess depreciation. If they don't have, the revaluation reserve will stay at the full amount. The full amount is 0.8. So think about it. If they have a policy for transfer, they would have transferred out 0.1 to the reserves already, from revaluation reserve to retained earning. So the revaluation reserve will drop from 0.8 to 0.7, right? Does that make sense? So very simple. The mathematics of it is, you just compare these two. 7.7 to 7. How much is it? 0.7, right? That one go to reserve. Take out from your reserve. Okay? The difference between 7 to 5.5 is called P&L. Are we okay? So this is one step. So if I was to show you this in a different way, I'll put something like this. If policy got, then it's 0.7 and 1.5. Can you see this now? If no policy, then it's going to be 0.8. Pay attention, 0.8, and then the other one is going to be okay, let's go through the steps again. Okay, I'm going to go through the steps one more time. If there is a policy, the way you calculate is done. That one go where? OCI. This one will be, that one go where? P&L. Okay, are we okay in this part? Got it, Got it? Okay. If there is no policy of transfer, the first one is oops, 0.8. Got it? Which one is it? It's compare these two first. Are we okay now? Second one, compare these two. These three. 7.7 minus 5.5 minus the 0.8. Okay. You need to know the sequence here. This is quite important for you to know because you can lose easy marks. If there is a policy, the answer is different. If there is no policy, the answer is different. They will see whether you do it correctly or not. Are we clear on the sequence? Yes, no? The first one go to where? The 0.8 go where? The 0.7 go P. This one go OCI, OCI. This one go P&L, P&L. Got it? Can? Do you understand the treatment? Yes, no? Can I move on? Okay. So let's go to the last one. Key committed itself at the beginning of the financial year to selling a property that's being underutilized following an economic downturn. As a result of economic downturn, the property was not sold by the end of the year. The asset was actively marketed, but there was no reasonable offer to purchase the asset. Key is hoping economic downturn will change in the future, therefore has not reduced the price of the asset. Okay, now the last one is they have classified the asset as what? It looks like they are committed to selling the property, yes or no? Okay, so we talk about this one first. Third asset, this is called the Okay, do you understand what I just wrote there? That's the whole list for IFRS 5. Does that make sense? Are we okay there? Yes, no. Can? So, clear on IFRS 5, first all the basic theoretical requirement, main theory. Can? Okay, next one. What's going on over here? Third asset, you got depreciation. In this case, what's going to happen? Held for sale, met or not met? Met or not met? That's all you have to say. Give reason, that's all. Not met. Why? Well, you can say it is not held for sale as the management are waiting for economic indicating committed to sale, isn't it? Correct? They have not reduced the price, implying that price set is not reasonable for a sale to occur. Not got any interest done. Okay, done. Does that make sense? Any questions there? as long as you're going to say things like this about the company, you get marks. Make sure you're doing this section. This is called application. That's called theory. Okay.